Never take advice from someone who doesn't have to live with the consequences. There's no such thing as a free lunch, yet with social media, everyone's offering financial advice free lunch. 25-year-old life coaches love to emphatically warn you that what they're saying is not financial advice, but then they proceed to lead you in the worst direction possible. I spent 1 decade in finance at an officer level, 2 decades investing, 3 years studying advanced finance topics, and I have 4 degrees, one of those being a master's in finance with a focus on risk management. What I'm going to tell you today is not financial advice, but it's going to help you avoid losing money. I will show you how to make sure your financial advisor isn't screwing you over. So let's start with the 2 most important things that you need to know. Morningstar did a study and they tried to find out what the top performing funds had in common. And you know what it was? The biggest predictor of a top performing fund was low fees. The old saying, you get what you pay for, doesn't apply here. You know why? Because 95% of active managers, those are fund managers who try to outperform the market, 95% of them can't do so in a time period of 20 years or more. That's according to an ongoing study by S&P Global. Problem is, it's extraordinarily difficult to beat the market, and active managers charge a lot of money to try to do that. So you end up paying more money, and when you pay more money, we know that results in lower performance, and you don't get any performance. You actually get underperformance. So investing in active funds is a really bad idea, and the industry is waking up to this. It's something we talked about in our recent piece on active managers. Here's how you solve this problem very simply. You need to figure out what fees you're paying for your investments. Always start at the product level. You can practice on your 401k or your pension or whatever retirement plan you have through your employer or past employers that you probably never look at. So when Gwyneth from HR comes back from her jet-set holiday to Paris with her MD boyfriend to go handbag shopping, ask her how to access your retirement account and figure out what fees you're paying. Let's take a look at one example from a Standard Life account. So they're a large UK provider of pension services. So here you can see the breakdown of this real life account, and it's no surprise to see most of the allocations are for Standard Life products. Now there's no fee to hold this account, but they are collecting fees on the products, and here you can see along the bottom the charges. They often like to do this, so they have these lofty charges, then they discount them to make it look like you're getting some sort of a deal, but the actual truth here, what you pay. So 55 basis points roughly. I guess the first question we would have is this good or bad? Now, we know what the answer is for that in the United States, but for each country, we need to have some sort of a benchmark. So what we can do is download this international fee study by Morningstar. And since around half our audience are outside of the United States, for each of your countries, you can then take a look and see what fees you ought to be paying. For the United Kingdom, you see here that UK domiciled funds carry median expenses of around 84 basis points for equity. So what we're being charged in that Standard Life account isn't half bad. But when we break it down by product, as you see we've done here, look at the product on top. So it's a Standard Life BNY Mellon. So that means that 2 entities are collecting fees. It's a real return B pension fund. And you see here that it's charging 1.13%, which is exceptionally high. So it's actually pulling up the fees across this entire account. And when we look at what they do, I'm not going to read the verbiage across the top, but I'm going to tell you that whenever you have these funds that try to do something like take a benchmark and beat it by just the smallest amount, they always seem to fall on their faces. And here you can see, I think the technical term they use in the UK to describe an investment vehicle like this is rubbish. So they're trying to do something very simple and they're failing miserably. You can see there on the right the different types of products they're using to do this. And the fund managers are going to get paid either way. If there's underperformance, it doesn't matter. This probably has a lot of AUM tied to it because nobody really looks to see what it does and how it's performing or what they're paying for it. This provider of pension services is sort of a financial advisor, a self-directed one, in that they say, here's the list of products you can invest in. You want to have an external benchmark. So let's take the next item in this list. It's the Vanguard, so that's good. We like Vanguard, they're low fee. Emerging Markets Stock Index Pension. So what does that tell us? We're getting emerging markets exposure, but we're paying 66 basis points. What we can do is go out and take a look for a substitute product. Here you see FTSE Emerging Markets UCITS ETF. So that's a European Union fund for getting exposure to the emerging markets. You see their ongoing charges, 22 basis points. So you're paying 3 times that. What they're likely doing here is adding on to those Vanguard fees quite a bit. And then for the half of our audience that's from the United States, you can use this fund as a benchmark. You're paying 14 basis points. So why would you pay Standard Life so much money for that exposure when you could get it cheaper somewhere else? And for the American investors, since they're just slightly the majority of our audience, what you can do is pull up this again from Morningstar, this table that shows fees you ought to be paying. And here we have active and passive. Remember, active is where a manager tries to beat the benchmark and passive is the benchmark. Look at that. So almost 6 times, 5 to 6 times more expensive for active funds than passive. Remember what we said about active? Over 20 years or more, 95% of active managers can't beat the benchmark. So you're paying for underperformance. It's very important to note. So the takeaway here, takeaways, do not pay fees in excess of the average presented in the previous table for passive funds. So you should be paying what's average. That makes sense for your country. Your financial advisor is going to try to sell you on active funds for any number of reasons, mainly that they don't make a whole lot of money on low-fee passive funds. So always focus on exposure. What index is this fund tracking? For an active fund, what benchmark are they trying to beat? Then point out the equivalent exposure you can get with an ETF. Always point to Vanguard's ETFs and funds. They're the lowest cost in the industry. So when you have a conversation with your financial advisor, you should be pointing this stuff out to them and seeing how they respond to that. And if your financial advisor is going to continue charging you too much, go somewhere else or replicate the work that they're doing for yourself. So an absolute must here. I talk to a lot of our premium subscribers that will say things like, well, I don't really know how much my financial advisor charges, but I'm not happy with their performance. Well, then that's 2 strikes against you. You absolutely must know what you're paying them, and then you can start to assess performance or lack thereof. Does your firm charge a flat or tiered fee for assets under management? What fees are you paying for each product your advisor has you invested in? Any advisor whose stock picks is a total muppet and they should be kicked to the curb. That's a very bad idea. It's a lot of abnormal risk, and as we know over time, unless you're Warren Buffett or someone with equivalent capabilities, you should not try and stock pick, and especially this holds true for Joe Retail Investor. If you have debt, this is a question that often comes up. Should I pay off debt or invest in the market? It's generally a good idea to pay off your debt before you invest money, and zero interest student loans would be the exception. I spoke with early in my career financial advisors who said, well, you should invest in products and disregard your debt, just pay off the minimums. And then that was a really bad idea because the minimums were against an interest rate that was fairly high. They just wanted a commission on the products they were trying to get me to invest in. We're going to talk about how they make money and their incentives. You can understand somebody very well by understanding what motivates them. Use common sense. So remember how we said there's no such thing as a free lunch? Unless you have a lot of money to invest, don't expect low fees or any sort of personalized advice that's any good. The average financial advisor brings down $75,000 a year. Why is someone who makes $75,000 a year telling a millionaire how to preserve their wealth? This financial advisor is just getting his feet on the ground while you drove up to the meeting in a Rolls Royce. Millionaires don't take advice from average financial advisors. They use what's called private wealth management services. So most people who have a personal net worth, let's say in excess of $10 million, are not that comfortable at all with just moving their money around and making investments with it. So they need to be reassured. They want to pay experts. They need to see that the place they're investing their money in is real. They need to be assured by visiting someone named Alistar. They want to see sophistication, a Rolex, a Ferragamo tie. At this wealth level, you're really able to fend for yourself, but the same general rules apply about fees and passive and active products. The biggest contributor to wealth later on in life is how early you started. So it's very important you don't make mistakes at this stage, but everybody does. So you want to get those mistakes out of the way. This would be the 10 10K to 100K types. Then you have people, let's say in their 40s, they have some wealth now. Preservation is as important as growth. Maybe they're in the $500K to $1 million range. Then you have people in their 60s, let's say they're in several millions or more. If they just invested in a simple 3-fund portfolio, they probably would have several $1,000,000. So let's focus on the 20s and 40s risk profiles. I think these individuals are usually attracted to the bog standard financial advisor that really tries to market themselves heavily. I'll use Edward Jones as an example. It's a good example of a financial advisory service that isn't very good at all because of the fees that they're charging. So you can see here, minimum investment $5,000, fee-based starting at 1.4%. So far, based on everything we've been looking at, this is exceptionally high. And then look, they're also going to charge you when you buy and sell investments, generally ranging from 75 basis points to nearly 6%. So this type of a firm isn't very good for the individuals in their 20s or 40s. That's where you have to look at what you're getting when it comes to basic financial advice. You can get that from a robo-advisor very cheaply. We've been covering robo-advisors since they started, and on the left, you see from an old piece that we did on robo-advisors, the leaders. The methods that a financial advisor uses are pretty standard across the board. They should be. There are things like 100 minus your age, and that's how much you should have in equities. Rules like that. These can be easily automated. In fact, it's better if they're automated. It takes emotion out of the equation. That's what robo-advisors do, and they charge very little. Let's say 30 basis points for the service. So you see here, on the left was when robo-advisors first started, and we were working with some of them. On the right, now you can see the largest, Vanguard's digital advisor offering. We're going to talk about that. Then you have Empower, I'm not familiar with that, and Schwab Intelligent Portfolios. And the original robo-advisors, Betterment and Wealthfront, they're still kicking. But there's one thing a robo-advisor cannot provide. And again, here's a study from Morningstar. They put out quite a bit of good research. Most people hire financial advisors for emotional reasons. And you can pause this and read the reasons for yourself. But they're nearly all based on emotion. And we see this ourselves. I know that when the market starts tanking, I get contacted left and right by our premium subscribers, ask, is everything okay with them? You see this in Google when people always ask, why is stock XYZ falling? They never, ever ask why it's going up. It's always, why is it falling? And that's because people's emotions start to get in the way when you have market corrections. And we're inevitably going to see that in the next bear market. So how do financial advisors make money? Well, you look at Fidelity's zero fee funds. People say, how can they offer these? Or maybe they're just loss leaders. Well, they don't necessarily operate at a loss. What Fidelity can do is loan shares out from those funds and make money on that. ETF providers can as well. In our recent piece on the best guide you'll ever come across to investing in ETFs, we covered this topic, how ETFs make money. So advisors can have relationships with product providers. I think Edward Jones does this. Standard Life, as you saw, did that with the BNY Mellon example, where they offer other firms products and then either add some on top of that or get a little commission for the money that they push in that direction. Always understand what you're paying the advisor for a product and then benchmark that to external products with the same exposures we showed you how to do. Some financial advisors will charge a flat fee based on AUM. Well, put that into the equation as well. Go look at the product level and then look at the flat fee level. So what do I do? Well, managing my own money is what I prefer to do. Financial advisors have nothing to add but additional cost. I've learned to eat my own dog food and take my own advice. It's not advice, of course. I have no shortage of people to bounce ideas off of, so going back to that emotional need that a lot of investors have. And my own personal situation is quite unique. I have multiple citizenships. Most of my time I spend outside the United States. I have a business that I'm running that I invest in. So it's a rather unique situation. My accountant is excellent. That's perhaps one of the best things I ever did. I'm happy to do intros for American expats. My accountant specializes in expat situations. I try to keep my life and investments as simple as possible, and I think you'll do very well if you do the same. What I suggest is that you be absolutely certain what you are paying for. Every product you hold, every individual you engage with, what are you paying them for and what are you getting in return? Don't be afraid to engage with multiple entities. I think this is a really good idea. Have a couple investment advisors and then bounce what they're saying off of each other, right? You can use that as leverage. So maybe you have $500K with Vanguard, $250K on your own book, right? So you manage manage some of your own money and see how you compare to your financial advisor. $250K with Fidelity. So spread that out. But which financial advisor, Joe? I know everybody wants to know names. Well, what you can do and what we do when looking at companies as investments is we always look to invest in leaders. So you can always look to invest your money with leaders, and usually you can't go wrong there. Why? Because they'll typically be very competitive on cost. Their employees are typically quite competent, and they manage reputational risk. So if something catastrophic happens, they're going to make sure that everybody's made well. And they operate at scale so they can charge lower fees. For example, Vanguard's digital advisor. Here you can see they calculate the costs on 100K, you're paying 20 basis points, but they have a refund. Remember we talked about the refunds and discounts associated with that. So I think for the Vanguard robo-advisor, you're paying 15 basis points. That's pretty good. When you could run a 3-fund portfolio for lower than that, but this isn't half bad. And then they have a hybrid offering for around 35 basis points. So they're using that digital platform, but then you have a personal advisor you can speak to. You need to have at least 50K on their platform to have that. And that isn't half bad to have a human to speak with. And at least you know they're going to be pushing you towards Vanguard's products, which are some of the lowest in the industry. So for those of you that want to manage your own money in perhaps the most risk-averse way possible, I put up this piece on the 3-fund portfolio for Mr. Bogle, the founder of Vanguard and someone who brought us low-fee funds. Give that a watch. Thanks so much for taking the time to watch this today.